Great news for Tesla as today we had BP sign a $100 million deal to acquire charging hardware units from Tesla. But what's interesting is that this is the first time that Tesla chargers will be purchased for an independent electric vehicle charging network. In fact, we hear someone from Tesla saying that selling our fast charging hardware is a new step for us and one we're looking to expand in support of our mission to accelerate the world's transition to sustainable energy. So what we've seen in the past is several other automakers adopt the supercharging network for Tesla, which means that going in the future, we're going to see revenues from energy for Tesla and other services increase. But we have to understand that this is going to be something that takes time because, of course, a lot of these cars or automakers joining the supercharging network won't actually start until 2025, 2026, and beyond. And so that's revenue that Tesla doesn't see immediately. And so what's interesting about today's deal is that this comes as like upfront money for Tesla. Yeah, they won't get the charging revenues over time in the future, but they get this huge wad of cash coming in for, these companies buying their actual hardware units, which is a huge boost for Tesla. So we could potentially see other companies like Exxon, Shell, Chevron eventually go ahead and follow suit, just like what we've seen with automakers pretty much adopting the supercharging network. And so this is good on so many fronts because one thing that we could start seeing in the future is that ICE vehicles going to the gas station to go ahead and pump their vehicles are going to start seeing Teslas lined up more often and actually getting charged up there as well, which again is kind of like a little bit of an advertisement, but that's just a side note. One of the main things is just the upfront cash that Tesla gets when these companies buy these hardware units. Now, I know some of you guys may ask, well, if this is great news for Tesla, why is Tesla stock down? But one thing that we have to understand is that both sentiment and mathematical factors are what drives the market. And right now, we're not in a good area in terms of sentiment. Think about the geopolitical concerns and also what's going on with treasuries. And so a catalyst event like this is very short-lived. We did see Tesla stock pop up for today, but it ended up pretty much driving downwards as well as the overall markets because, again, things are not looking that good overall. And so I want us to take a look at the overall S&P 500 index ETF, ticker symbol SPY, because what we're seeing is that along with bad sentiment going on, we're also seeing the overall markets fall below its 200-day moving average, which is the green line I have depicted right over here. And of course, that's the mathematical factor that's driving things down as well. And so essentially what I'm saying is that when you have macroeconomic pressures as well as geopolitical tensions causing to sour the sentiment for the overall market, that causes prices to go downwards. But as the prices are going downwards, well, now we're seeing stocks break technical trends, hence what we're seeing with the overall S&P 500 below its 200-day moving average. And then what that does is it causes the market participants who look at the market from a technical perspective say, oh wow, the markets are down below its 200-day moving average, now it's time to sell. And so essentially what you're seeing is this kind of snowball effect. There's this combination of multiple variables causing prices to sell downwards, which is why we're seeing capitulation take place with the overall markets as well as Tesla stock. And the reason why, even though you have a positive catalyst event, it's not enough to take or really absorb all the selling pressure taking place.
This is bad.
Now, before we go ahead and move on with the video and talk a little bit more about Tesla stock and the overall markets, I do want to provide a friendly reminder to make sure to hit that subscribe button. This way you don't miss out on any future videos if you're not already subscribed. And also consider checking out the links in the description of this video as well as in the pinned comment section below, because there is going to be a link for my free weekly market pulse insights where every single week I send out an email talking about what's going on with the overall markets as well as what are some things that we should absolutely be aware of. And again, guys, it's completely free, so make sure to check out that link down below. But with that said, I want us to take a look at this. So today we got the third quarter GDP numbers, and what we're seeing is that the economy is still on a path of growth. Now, this makes sense considering the fact that the labor markets are still insanely robust, which means that individuals have a job, they're able to get their paychecks, and when you have a job and you're able to get a paycheck, you're able to go ahead and spend that paycheck, which is why we're seeing consumer spending still at these high levels. But of course, one thing that we have to understand is that while the central bankers or the people in the Federal Reserve want to see the economy grow, they don't want to see it grow at these rapid levels. Hence the reason why we have rates high. They're trying to stifle the economy. They're trying to slow down the rate of growth, and they want to see the economy grow but at a below trend. And so this is showing that the things are still pretty hot, and means that rates are probably going to be higher for longer than we expect. Now, of course, I still don't change my idea on the belief that the Feds are most likely not going to be hiking in their next meeting in November 1st. I still stand on the belief that it's entirely too premature to go ahead and hike rates an additional time, because at the end of the day, you have to understand that rates take time to really filter into the economy. And so right now, I'm pretty sure the central bankers are looking at this data and shaking their head. They don't want to see the economy grow at these rates, and that's probably one of the reasons why we also saw the market sell off today as well. But with that said, I want us to go ahead and hop into my laptop. This way we could go ahead and take a closer look at Tesla stock from a technical perspective, as well as just cover some additional topics that we want to be aware of, regardless if you're trading Tesla in the short term or investing in Tesla in the long term. Alrighty, so we are officially in my laptop taking a look at Tesla stock, and as we can see, yet another red day for Tesla. In fact, if we map it out from the close of yesterday to the close of today, about 3.3% down. And one thing we could see is with the price action, we had the GDP report come out at around 8:30. Markets were pushing up. Tesla had the good news. It ended up kind of moving up to this level of 213, and then pretty much fell downwards alongside with the overall market. So if we take a look at the overall S&P 500, same price action. And so definitely a bit concerning, especially because if you look at Tesla, this has been the overall direction for quite some time. Ever since its earnings on the 18th, we've been seeing Tesla stock fall down quite a bit. Of course, we are seeing some consolidation around this range, which makes sense considering that when you're looking towards the right on the volume profile, we see that there's a big shelf or a lot of volume relative to price, and so that means that there's a lot of exchanging at these levels. And so that's the reason why you see Tesla trade sideways, although we're falling below the shelf, which is a bit concerning. Now, as you see, when there's this volume pocket, that's where we see when there's selling pressure, it's amplified. There's a lot of selling. Tesla fell the most during these areas, which is why when we take a look at a daily time frame, I say these are the biggest areas where we see the biggest swings for Tesla. When there was a lot of buying pressure for Tesla and there's little volume, pushed up the order books. When there was selling pressure, pushed down the order books, buying pressure, etc. Right? And so one of the things I've recently mentioned is that although these areas have been an area where we saw Tesla stock bounce the last time, I wasn't necessarily convinced that this was a time to go ahead and add into my long-term portfolio. Of course, everyone's free to trade or invest in whatever they see value in, but if you watch my videos from a few days ago, which is why I don't delete my videos on YouTube, I think it's important to keep something on record. Your word means everything. And so if you guys just happen to glance on those videos, I've been saying that this was not a good area or a good sign for me. There wasn't a lot of confidence to go ahead and add in long, and what we're seeing is more selling. In fact, I even said it when Tesla stock was pushing upwards. We saw Tesla pushing upwards, but this candle over here, you have to also look at the candles. When you see this wick over here, that means that there was rejection, there was selling taking place. And so as it was pushing up, more sellers stepped in and caused the selling to go, or the price to go downwards. And so that weakened my confidence for Tesla bouncing up at these levels. And that's the reason why I don't plan on adding into Tesla for quite some time. I'm still waiting to see if Tesla falls down to this lower shelf of volume relative to price, because as it continues falling down, around over here is where we're going to see more exchanging of buyers and sellers, and so that could act as a floor. And we also see that around over here, it's been a resistance in the past, and so when there's previous resistance, it could act as future support. Again, not necessarily meaning this is exactly what's going to happen, because at the end of the day, technical analysis is not to predict the markets, just to measure the market. Stocks don't have to adhere to whatever price action. I mean, tomorrow we could very well get news that, I don't know, Elon Musk dies, and it could just blow past this if that were to happen, right? So that's why I say you can't look at technical analysis with too much emphasis. It's definitely something with little weighting and analysis, and within the analysis that I do. But it's something that I still pay attention to, and that's why earlier in the beginning of this video I said, hey, looking at the overall S&P 500 index, this is bad, right? we saw it break below this $4,200 shelf, where we saw in the past it was a resistance. It acted as a resistance again until it broke above it, acted as a support, and recently just broke below it. And so that's what's causing that technical selling, along with the fact when you look at the overall S&P 500 index ETF, right? It's not the index, it's the index ETF. And you actually, let's go ahead and, I don't really use a lot of indicators, but if you add the moving average, which is what I was showing you guys, the green line over here, the 200-day moving average, it's down. And so that's not a lot of confidence there when you see stocks actually fall down below their 200-day moving average, right? That's typically a sell signal, which is why maybe the algorithms now are triggering the sell as well, right? First you have the human nature of trading, where individuals are trading based on news and data, and then once you break a technical level, maybe the algorithms get triggered, and that's what causes more selling pressure, right? So that's why I mentioned that earlier. But in regards to Tesla stock, we definitely did get good news today. It'd be very exciting if, as I mentioned, as we saw a lot of the automakers join the supercharging network, what if all these mega retail gas stations start buying an enormous amount of Tesla hardware charging units as well? Imagine we see Exxon and, as I said, Chevron. That could be good. Although, as I said, good news right now isn't received too well. It's taken with a little grain of or a small grain of salt. I can't think of the right phrase, but essentially what's really matters right now is fundamentals and the macros. And I spent much of the year questioning a lot of the valuations, not only just Tesla, but a lot of the tech names, right? I spent the majority of the beginning of the year questioning these valuations, emphasizing that earnings will eventually need to justify, right, these high prices. I've also pointed out that high valuations in this climate means that there's no room for errors, right? So that's why when we're seeing these earnings, we saw, let's take a look at Meta real quick. I believe, let's take a look at that. Oh, okay. Meta kind of is holding up again, but we saw some decent earnings. Meta beat its earnings, yet Meta actually closed down below. And so what I'm trying to say is that there's very little room for error. So if there's anything in the earnings report that shows that maybe going into the future there's weak forward guidance, that's going to cause selling pressure, right? Right now, especially this issue with geopolitical conflicts and fluctuations in treasuries, any mistake, any little thing is a sign of concern. And so previously, big tech companies could get by with a vague forecast. They could say, oh, well, I still think things are going to be okay. They could say things like that. But now we want to be a little bit more specific. And so investors are no longer lenient, right? Just as we saw with Meta, this is a prime example. And so it's important to note that the big seven stocks, and when I say the big seven, I mean like the magnificent seven everyone refers to, Amazon, Microsoft, Google, Meta, Facebook, Tesla. You guys know Apple, right? The big seven, right? They account for over 75% of the market's upward movement for this year. For example, when we take a look at let's look at SPY, right? In the beginning of this year, when I did say things were going to start bouncing up, especially after this horrible, let's go to a weekly time frame so we could see better. We had a horrible 2022. The beginning of 2023 was pretty good. That's something that I said we're going to start rebounding. But as we got closer to the second half of 2023, I said, hey, these big seven tech companies, they're holding up. They're the reason why the overall market pushed up. They make up 75% of the market's upward movement. And so if that bubble bursts, that impact could be equally devastating, right? In fact, if we take a look at I want us to remember this image right over here, right? Because this is the S&P 500, how it's weighted. But if we take a look at the S&P 500 equally weighted, which is RSP, right? We see that that's actually falling downwards. When you account for all the stocks in the market equally weighting, it doesn't have that upward trend for 2023 like we saw with the overall S&P 500 with the regular weighting. And so that's concerning. We're seeing things sell off. And that's why right now, even though we're having good news for Tesla that I believe is great news for the long term, it's not necessarily going to do much right now. Of course, we'll have to wait out. We'll see when price falls down. Let's go back to a daily time frame. When price falls down to these $180 levels, perhaps that's more of a better multiple for Tesla, and that's when more buyers will possibly step in. Of course, we'll have to wait out and see. But again, right now is just not a good time, so bad news is going to be amplified. But with that said, I want to keep this video very short, sweet, and concise. I don't want to overwhelm anyone. We won't look at treasuries today. I think that'll be a topic for another video. But with that said, before you guys go, make sure to watch this next video right over here. Or if you saw that video, make sure to watch this video right over here explaining why I don't trade penny stocks. I'll see you guys on those next videos. Take care.